Explain to me your footprint in this region and why it was important for you to be here.
Absolutely. I mean, we've been managing money for clients in the regions for decades, and I make regular trips out to make sure I'm understanding what our partners and clients need. But what that's enabled us to do is really see the trajectory of change in the entire Gulf region over the last 5 years. And it really is quite extraordinary. And I think there's no better example than here in Abu Dhabi, where, you really see the entire diversification of the economy. And you're starting to see the movement from what were sort of grand plans to actual tangible changes now in how money is being invested. And so this year, we felt that the time had really come to have boots on the ground. So we have now opened an office here in Abu Dhabi, and we have a very talented staff in place. And I think that that's going to enable us to be even closer to our clients and also to partner with them as more investment actually goes in to the Gulf economies rather than simply managing money in other parts of the world for them. And I think that partnership is ripe for now, and we're very excited about it.
So you've been speaking with stakeholders on the ground here and around the region. Give me a temperature check on 2025. What are your expectations?
So I think that there are two strange things that I would pick up around the conference. One of them is everybody feels that risk is really kind of somehow elevated, that there's geopolitical risk and there's risk to new changes and administrations, and yet volatility is very low. So you see risk everywhere except in the volatility measures, which is a particularly interesting piece. The second thing is that people say it's a good time to invest. Because they do believe that maybe the U.S. economy and other places have, headed for a soft landing. And yet, Dan, everything is expensive. So, you could say maybe that your mean plan is for a soft landing, but you're not really getting paid to take the risk. So we're actually running a lot of our portfolios at about half their risk budgets at the moment, not because we think bad things are going to happen, but because we don't think you're getting paid for the upside at the moment.
Right. So when you look at equity allocations specifically, it's a party right now, particularly post-election. Dow 45,000, S&P 500 and NASDAQ tracking at record highs as of last week. Is there some nervousness now about perhaps over-indexing to the United States given current valuations?
I would say absolutely. I mean, the rotation around the globe of capital is extraordinary. I mean, you really don't see money moving into Europe at this point. I mean, people feel as if the economies are not growing, productivity hasn't moved. You do see optimism in Japan. You see optimism in Southeast Asia. And, here in the Gulf countries, you really feel optimism. And in the U.S., the economy seems to be doing better than I think any of us would have, thought a year ago. But what that means is that more money has rotated into the U.S., into Japan, in Southeast Asia, and out of Europe, and there's no more money going into China. So most CIOs are sitting back from that and saying, I'm over-indexed to the U.S., but I don't see much of an alternative, and I'm nervous about it. And so that is the general feeling, but most people are not pulling back from that over-index at the moment.
Right, and when you look at the business cycle and interest rate risk now, where do you see the equity-bond correlation moving in the year ahead? A lot of nervousness about what the incoming Trump administration is going to do for the inflation trajectory. So what does that mean for positioning in these markets?
There's certainly, I think, a renewed worry about, inflation, while it seemed to have been kind of beaten down, actually could make a bit of a revival. The other thing is, we had elections around the world. It was really the summer of democracy in many ways. And we can argue about who won, but the big group who lost was government balance sheets. And, all around the world, fiscal rectitude was not on the political agenda. And so we are certainly quite worried about the ballooning government debts, not just in the United States, although we'll certainly, I think, see more of that, but also in parts of Europe and in the emerging economies. And so we're watching that level of debt very closely because that will drive, together with the inflation, a lot of the answer to your question on the stock-bond correlation.